Hello, and welcome to this week's topic. We're talking about margin lending and options this week. Let's see how we go. So just a bit of a refresher first on shares. So remember that when we own shares, we're owning a small part of a company. It means that we can share the profits of the firm. So we do that by receiving dividends if they're paying out dividends that year. So they're representing equity. Now remember, if you're an ordinary shareholder, then you are the residual owners of the company. So the word residual, what's left? There's no guarantee that you're going to receive any dividends. Those preference shareholders, they've got the first right. So the preference shareholders, they receive the dividends first. Then if there's anything left, the ordinary shareholders will. Now shares are great because you can choose specifically which company you want to invest in, so you can tailor your portfolio how you wish. You can choose between companies that pay dividends and will give you that regular income, or perhaps you prefer to choose ones that don't pay dividends but you're expecting that they'll have growth, and that's how you increase the value of your portfolio. So different shares for different people are available. And when we look at our risk return graph we've got here, so we've got very low risk, low return cash, and our fixed interest, our bonds, and then we move along. We've got our hybrids and our property, and then we have shares. Now, of course, there's a range, as with any category, but they are higher risk, but also that should mean a higher return. Have a look at this chart here showing the performance since 2001. This is based on the ASX 200. So that's for the top 200 shares. So it's a good reflection of what's happening in our Australian market. So the best 1 year return, 1986, probably seems a long time ago now. But that was 52.2%. That was a huge return. The worst 1 year return is minus 41% back in 2008. So remember, we didn't have a recession here. We were actually very lucky here, but this was the global financial crisis with all the issues in America with lending to people who couldn't pay back, and eventually it all toppled over. Okay, so this is a representation of the market, the ASX 200. It's not necessarily mean that the shares that you've picked will have done that well. Our individual shares that we choose may react completely differently. So at the start of 2020, the index amount was 6,684, and then by May, of course, we've been in lockdown. Everything was, we were very distressed back then, wondering what on earth was going to go on. Did we have jobs? A lot of people were losing jobs. You can see the index has dropped down. By October, it had gone back up to 6,120. So have a look at what it is now. See how the share market has gone now. When we're buying shares, we can choose between two different strategies. So the traditional approach that we would take is to buy them and hold on to them for a long time. So this is the long position. It's the most common way that we would buy our shares. So we buy them now. We've often talked in class about holding our shares for at least 7 to 10 years. So buy, and then in 7 to 10 years, sometime in the future, sell them, and we hope to get a profit then. So we're trying to buy low and sell high. Where do we get our returns from? Well, we get them from dividends if they're a share that pays dividends. We'll also hopefully get capital gains, but we'd have to subtract off the costs. So we have brokerage costs of buying and selling them. So that's the traditional approach that you'd be familiar with. The other way is the short position. So short selling is when you sell shares you don't actually own, with the intention that you'll close the position by buying back those shares sometime in the future. So you would enter a short sell position with the aim to profit from the stock price going down by selling it at a higher price and buying back at a lower price. So investing short refers to a position that profits from the asset price falling. So when people believe that the share price is going down, this is when they would try short selling. Here's an example. So if we buy our shares at $40 here, and then later we sell them back at $54. So this is an example of the traditional way of long selling. So we buy $40, sometime later sell back at $14, a $14 profit, we sell at $54. Now the short position is on the right side. So we borrow those shares, we sell them up here where the price is high at $58. The price goes down and we buy back at $42. So we have made a gain of $16. Of course, there are costs that have to be taken into account for this. So there's the two, the long and the short. So the long position is relying on the price going up and the short position on the price going down. But the long position has the advantage of time. We would normally do this over quite a longer time frame. So you've got that advantage. Short selling, we'll discuss it a little more shortly, you'd want to be doing that over quite a short period, short time frame. Let's go on, have a look at the next one. So short selling, this is a strategy you'd use if you're expecting the share price to decrease. So to sell short, you sell shares of a security you don't actually own, you borrow them from a broker. After you short a position through a short sale, you eventually have to buy back the shares to close the position. So that means you've got to buy the shares later and return them to the broker from whom you borrowed the shares. You'd make a profit from short selling if you buy back the shares at a lower price, so if the price goes down. When you trade stocks traditionally, we buy low and sell high, the maximum amount that we can lose is the amount we originally invested. So if you buy shares and they cost you $30 each, the most you can lose is that $30. It would still hurt, but it is the most. If you're short selling, your losses could theoretically be unlimited because it's based on the price going. A loss would be if the price went up, and the price could go up indefinitely. So the higher the price goes up, the more you lose. You also have to pay interest on the shares that you borrow. It's like if you're like lending money, just the same thing. Someone's going to charge you interest. So if you're borrowing shares, they're going to charge you interest as well. And this can be quite a significant amount, perhaps as much as the actual value of the share itself. Let's have a look. So an investor believes stock A, which is trading at a price of $100 per share, is going to decline when the company announces its annual earnings in 1 week. So the investor has two choices. Don't buy the shares, there'll be no loss, no gain. Or they could short the stock, which could give them a potential gain from using this strategy. So to short stock A, an investor borrows 100 shares from a broker and they short sell these to the market. So they've borrowed them and they've sold them. So now the investor shorts the 100 shares of stock A. So remember, they didn't own them. and they're hoping the price will go down. A week later, they have the earnings announcements and the price falls to $90. So the investor decides that's a good time to close the position. So they buy 100 shares from the market at a price of $90 per share and return 100 shares to the broker. So this is buy to cover order. So the investors made a profit of $10 per share, which is a total of $1,000, but they also have to pay out of that commission and interest, brokerage costs for the purchase of the shares too. Okay, so let's have a look at this picture. Here we have our investor. So we've got our broker. The investor is borrowing the shares. They're worth $100 at the moment, and the broker lends those shares to our investor. Once they get them, they then sell them, 100 shares, to the market. Okay. Time then passes, a week later. Now remember, they're owing 100 shares back to that broker. They then go to the market and buy back 100 shares of stock A, and then they return these to the broker. Now they only cost $90, so they've got that $10 gap. They'd also have to give back to the broker the interest charges. So this is called buy to cover. What are the risks of short selling? Well, I've already mentioned some of them. So if the stock price increases to $110 per share and the investor decides to close the short position, they'll need to buy to cover the 100 shares at that current price of $110 per share. So their loss now is $10 per share, so they've made a loss of $1,000, plus still have to pay the interest to the broker. They'll have to pay the costs of buying shares because the stock price has actually gone up. So remember, when you trade traditionally, the most you can lose is the cost of your initial investment. But when you're short selling stocks, the price could just keep going, rising, rising. So your losses are theoretically unlimited. So the more the price increases, the more you could lose. So here we are, we buy at $40. We're expecting the price to go down, but it actually rises to $54. So the long position, that would be a gain of $14, and we'd be very happy. Here is our short position where we're selling at $58 and the price dropped, so that's what they were hoping for. So they've got a capital gain of $16. In our long position, we bought our shares at $40. The most we could lose is $40 per share if the price really went down or the business went bankrupt. Now, what about over here? How much could we lose? Ah, my picture is covering it up. Theoretically, if I just turn the camera off for a bit, we can have a look. No, it won't let me do that. Okay, so theoretically, the loss is unlimited. Now, how do you borrow shares? I mean, that sounds strange, does it? Can't go to the library and borrow them. So it's not really something that as an ordinary investor we could do. So it would be organized through a stockbroker. So to open a trade, you borrow the shares and sell them at the current market price. And to close the trade, you buy back the same number of shares and return them to the original shareholder. Another way is called naked short selling. So it involves a stockbroker placing a sell order on your behalf, even though you haven't borrowed any. So that's why they're using the word naked. So to close the trade, you must buy back the exact number of shares that you originally sold. So why would someone allow their shares that they own to be short sold. Well, they're getting all those fees and interest they can charge to that person. It could be quite a significant sum, but this is also why it's a short time frame that we're talking about for short selling. The benefits of using short positions: if the share market is going down, it's falling, then you'll make a profit. You can also hedge your portfolio to reduce drawdowns. So portfolio can be hedged with short positions to reduce drawdowns in downtrending markets. So should the stock market turn negative, any profit made in the short trades will help counteract the losses made in the long trades. Disadvantages: well, it's difficult to participate. So as ordinary investors, we really don't have the capacity to be able to do that. Few Australian stockbrokers have the ability to short sell, and those that do often have many obstacles: extra paperwork, collateral, pre-authorizations per trade, high fees, minimum trade size, for example, it might be $50,000 that they're expecting. The risk is unlimited. So remember, we talked about your risk with the traditional long method. It's no more than the price of your share. But with short selling, the trade isn't closed until you buy back the original number of shares sold, so your risk is unlimited. There's not an upper limit on how high a share price can go, but there's, the bottom is zero. There's a limited number of approved Australian Stock Exchange companies that are allowed to be sold short. So we had an example of distorting of the markets with Volkswagen back in 2008. So they had a massive short squeeze. The short sellers panicked because the share price was rising and they were losing money. To close the trades, remember, they have to buy back the original number of shares that they sold. So that meant they pushed the price up even further. So a snowball effect ensued. All the short sellers trying to close their trades at the same time pushed the price higher and higher. So the price of Volkswagen went from 200 euros to over 1,000 euros in just 1 month. Now, 2008 was quite a while away. But we've actually had a very recent example with GameStop. So we'll talk more about this in class, but go and do some research. There's a video there I've put up in the learning module, or you can easily go and look it up and read some articles or watch videos about what happened with GameStop and short selling. Okay, that's all for now.